Are you thinking it's a bad time to buy? It's not. And we want to have a discussion as to why. So today I've invited Scott and Zach to help us understand a little bit more about the market. And I just wanted to start by sharing a couple stories of buyers who are smart in today's market who have actually jumped in, and they're going to be so far ahead of the game. With Scott and Zach, we helped a couple. They saved some money, yet they needed some decent closing costs so we could buy down the rate. We were able to jump in and get a home of a divorced couple who had an urgency. They're very motivated sellers. So it gave us a perfect opportunity to get the right price, the right terms to get those first-time buyers into a house. We also had another couple. Well, not a couple, it was a single guy. And he was determined to find a specific home that he wanted. And again, it was another divorce situation, and he got a great deal. Now, both of these couples, a great thing about this is that they have the opportunity to refinance when the rates come down, but they can take advantage of the amazing opportunities and prices in today's market because if you have sellers, a lot of times they're divorce, their deaths, their job transfers. These are motivated sellers. And when rates come down, the tables are going to turn. And when prices go up, you can't secure the home that you want or the price that you want, the concessions that you want. So Zach and Scott, would you share a little bit more about this and you add your expertise?
Sure. We put together a few slides from a leading economist in the country. His name is Barry Habib. And he put out a lot of data recently that talks about why interest rates have not come down quite yet. And then historically showing the trends that when similar patterns of where we are right now have happened in the past, what does happen, and how rates do eventually come down. So let's just share that information with you. All right, here is the first slide. Can you see that? It says inflation drives mortgage rates. Okay,
Perfect.
so what you have here is this bottom line is the CPI, the Consumer Price Index, and that's a factor of inflation. And then above it, you have 30-year mortgage interest rates. And you can see for the most part, that those just follow together. So when one's going up, the other goes up. When one goes down, the other goes down. When they go sideways, they both go sideways together. But we got into this weird thing during COVID where the government just threw a lot of money into the system. And think about it. We all know people who got a lot of money during that time. And it kind of messed up the normal trends. And you can see that pushing that much money into the system caused prices to go up. So inflation did go up. And that's that CPI number, that pink number that's crossing over right in there between January and July of 21. It crossed over and went up, and it stayed up for quite a long time. And then it just finally crossed over here in between July of 22 and January 22. And you can still see that the blue line, even today, is higher. It hasn't quite corrected and turned and gotten back in line. But eventually what's going to happen is that blue line will get back into line with the pink, and it'll have the same basic margin between the two, and they'll continue to follow each other because that's historically what's happened for decades. So we do see a time coming when inflation is getting under control. There's no doubt about that. It is happening. Inflation is getting under, even though it doesn't feel like it, right? You go to the store and you're like, holy cow, everything's so expensive. But as painful as it's been, what the Fed is doing is working, and prices are coming down, and the economy is slowing down. Let's go to the next slide.
Yeah, as we look at the jobs report, this was fascinating to look at for September. We saw that full-time jobs went down by about 22,000. And then we also see that there was an increase in part-time jobs and also multiple job holders. So, I mean, as we're seeing this, there starts to be some cracks in these jobs reports where we're kind of waiting for one or two more jobs reports to come out that likely show like more layoffs as far as full-time work. And likely we're going to see there's typically an increase during the fourth quarter with the Christmas season where there are a lot more part-time workers that kind of just take on that part-time work for that fourth quarter, but then end up, first quarter of next year not being there. And so it'll be fascinating to see what comes out on this end, but this is likely what would cause the Fed to kind of say, hey, if we're starting to see bigger cracks on these jobs reports, we're definitely not raising interest rates. We're either keeping them the same and just maintaining, or we're actually thinking about lowering. And so that'll be the interesting thing that I'm going to be watching, at least for first quarter of next year. Now, the next thing too that we've been seeing is on 30-year mortgages, typically it follows the 10-year by about a 1.75 spread to a 2% spread. But because of how much volatility there has been with the Fed raising heights so quickly, it's now gone to about a 3% spread. And that's really, really unusual, because as we look back at like the last 30 years of data, it really has stayed around that 1.75 to 2%. And so we likely will see, once there starts to be less volatility, we'll likely see that percent go down to the normal 2%, which will make interest rates about 1% better over a 60 to 90-day period. Once the markets feel like there's some stability, there's some predictability about it. And so that'll be another helpful thing for mortgage interest rates.
So to put that into like real life perspective, Zach, what you're saying is the 10-year treasury, let's just call it 4.875 is about where that is right now.
Right.
And if you add 2% to that, then that means mortgage interest rates should be somewhere close to 6.875. But in reality, they're more like 7.875. And that's that extra percent you're talking about that the lenders have built in. The entire banking system has built that in right now because of so much uncertainty. And as soon as the Fed stops, that 1% will disappear. Is that what you're saying?
Correct. And that's what we're kind of expecting probably over the first to second quarter, that if the markets feel like there's enough stability, that would be peeled out relatively quickly.
Nice. All right. And then, the other thing I want to talk about is just historically, when the Fed funds rate gets higher than the 10-year treasury, it always leads to, well, at least historically here, we've got like out of the last 40 years, it's happened 5 times where this pink line, that's the Fed funds rate, exceeded the 10-year treasury note yield. And what happens right after that? Well, this grayed out bar is a recession. So the Fed says, oh, we pushed it too high, and then they have to bring it way down. It's kind of this boom and bust cycle. They push it too far and then bring it too far, and push it too far and bring it too low. And then you see over here again, it exceeded the 10-year. And what happened shortly after? A recession. Then they had to bring it way down, and they're forcing it down. It happened again right here, brought it way down. Remember when the Fed funds rate was 0 for year after year? It was crazy. I remember that. And then it happened again here, small recession. But look, here we are right now. And again, that Fed funds rate is exceeding the 10-year treasury. It's way above it. So you know that there's going to come a time period, just to what Barry's saying, where this is going to reverse itself and it's going to push back over, and the Fed's going to have to lower the Fed funds rate, bring interest rates down. And you can see historically when this happens, look what happened here. You got a 3.5% drop in interest rate. Here's a 2.5 drop. Here's a 2.5%. Here's a 1%. There's always this dropping of the 30-year mortgage rate. That's your green line whenever these cycles happen, and it pushes down. So on the other side of this, if we could draw this out, and who knows how long it'll take, it might be 6 months to a year, because these things don't just happen overnight. But what you were saying, Janet, there is almost inevitably a turn coming here. So there is an opportunity for people right now to take advantage of lower purchase prices, sellers that are soft, that have to move. If they can just stomach the fact that I'm going to do this, knowing that, yeah, I'm going to take a rate that's a little higher right now, but the odds are definitely in my favor that about a year from now, I'm going to refinance at a much lower rate. And the cost of the refinance with whatever interest I might have paid over that year is small in comparison to the amount of savings I could get right now on a house.
So your best weapon in today's market is to align yourself with professionals. It matters in today's market more than ever if you have a professional on your side, someone who's willing to give you a really solid education and who has some negotiation skills and some deep understanding of the market. That is how you're going to win. So if you or anyone you know is looking for some good education in preparing to enter the real estate market, we invite you to connect with us with no obligation, but we'd love to be your guides. So thank you, Scott and Zach.
Thank you.